Welcome to SilverOak's quarterly webinar. My name is Shannon King, and I'm President, Partner, and Chief Compliance Officer of SilverOak. And with me today, as typical, is Jonathan Charlo, also one of our partners and our lead analyst. Today's webinar is scheduled to last approximately 45 to 60 minutes. I suspect today's is going to take the full 60 minutes. We've got a lot of information to cover. If you have any questions throughout the webinar, please feel free to contact your SilverOak advisor after the session ends. If you're not currently working with a SilverOak advisor, feel free to contact me directly at 952-896-5701. And of course, I want to thank Jonathan, John, and the rest of the team that makes the webinar possible. It really does take a village to get all this information pulled together, including want to thank the folks on our technology side. For compliance purposes, I must note we will be discussing the overall markets and economy during this webinar. In doing so, we're providing our interpretations and perspectives. You should not rely upon this information as fact when making investment decisions. Also, we will not be discussing specific SilverOak portfolio performance, as each of our portfolios are customized. Nonetheless, all of our clients should have received by now their customized performance reports. If you have any questions on those, please reach out to your SilverOak advisor if they've not contacted you already. And lastly, past performance is no guarantee of future success. So let's take a look at the agenda today. We're going to start, as we typically do, discussing the economy and going through the SilverOak dashboard. We'll then transition to a discussion around the markets, brief overview of SilverOak's outlook as we move forward. We're going to today touch on some planning tips since it is the new year. And then we have a third part of our insurance series that we're going to touch on today, which is Jonathan, I believe, long-term care insurance. And then provide a few brief SilverOak updates. Again, if you have any questions, feel free to reach out to your SilverOak advisor, or even if you have suggestions for future topics to be discussed. So with all that, Jonathan, let's start with the economy and our dashboard. And this should be somewhat familiar to the folks that have attended our prior webinars, in that our dashboard is made up of four major components, the economy being one, credit markets another, market sentiment, and valuations. So those are the four components of the dashboard. What might look a little different this time around is that we have more colors of shading.
Now that's good for you since you're colorblind.
Exactly. You just tried to challenge me a little more.
But what we've done is we've added a light green to really show a little bit more difference between when things are very solid, and especially as they're coming out of neutral. And then same for red. We kind of have a pinkish color now to really perform that same sort of showing some clarity.
So folks that haven't attended, red's not necessarily good, it's bad. Gray's more neutral, green's good, and now we have the two kind of shades of red and green. Perfect. Well, what we do with this dashboard is we measure various components of these factors. So the economy, credit markets, valuations, and market sentiment. As a matter of fact, as an example, the economy actually has 24 subcomponents of it. Credit markets has like 7 factors, valuations 3, sentiment 8. But we take those, we measure each of the 4, and then we create a composite, kind of an overall view of the markets. If you look here and compare this to prior webinars, the shading is a little bit different because we have changed some of these, not just the colors, but some of the components or at least the sub-components, correct, Jonathan?
Correct.
So,
Yeah, so for the economy, essentially the major change is we did remove two LEI or sentiment components within the economy and use the underlying components that the LEI studies used. And as a result, what we saw was a little bit higher weighting in kind of consumer and labor market factors and a little bit less on the manufacturing side. And as you might remember from past webinars, we've talked about how strong consumer spending has been and that the manufacturing sector has been a bit weaker. And that is really acknowledging the trends that we were seeing really in the last year.
got it. And really overall, these changes just made it a little bit more sensitive and maybe a little bit more reflective of reality. So if we look here at the chart, laying out the dashboard going back in history, we changed a few things here as well. We took out I think it was a red line that was kind of a
Threshold.
Above it was positive, below was more negative, and now we've incorporated these different shades of either red or green or gray.
Yeah, absolutely. And so this is going to look a little bit different, but if we look on the far right side, you'll see that, again, we're moving up, generally speaking. And then when we look at the current component, which is in black, and the 6-month component of the dashboard, which is in yellow, you're going to see that we're kind of right around that edge of gray and the light green, and that's reflective of what we saw in the composite.
Got it. So let's dive into a couple of the subcomponents, and we'll start with the economy. Economy is one of the 4 major components, but one of its, subcomponents is the ISM index.
And on this slide, it is going to be different than what we showed last webinar where we had the manufacturing data. And that has been kind of below 50.
That's the black line.
That's the black line. And as you remember, I just said that isn't as big of the economy as many people think, but it's been a long running data series, and that's why a lot of people cite it. What we've added is the non-manufacturing portion of that, or people call it the services index, and that's been more positive. And again, now looking at the 2 and its weighting within our economic portion of the dashboard, it's really more reflective of what we're seeing in the economy.
Got it. Another component of the economy is the unemployment rate.
Yeah, and really, while we made some changes to the dashboard in the economic sector, what I would say is the economy has been relatively strong. And on this slide and on the next few, you're going to see that there really aren't many differences. The economy, from the unemployment rate standpoint, actually has come down a little bit from its height last year. But it is kind of a solid labor situation that we're seeing currently.
And to your point, when I first saw these slides, I wasn't even sure they'd been updated from the last webinar because there's just not much movement in most of this since our last discussion. Housing starts.
Yeah, so this is one area that has come down a bit, and essentially it's been an area that's been hit by the high interest rates, and that's kind of where we are currently.
Higher interest
Everybody
rates. Says high, and it's like, well, yeah, relative to history,
right?
Maybe not so much, but higher for sure. Relative
higher
to
interest rates,
yes.
And we'll talk about this later, but certainly interest rates did move up in the 4th quarter.
Yeah, they did. Yeah. Let's go into the credit markets. So this is another component of the dashboard, and here specifically we're looking at the yield curve.
Yeah, absolutely. And for a time we've been inverted, meaning that short-term rates have been higher than long-term rates. But with the move up in longer term interest rates in the fourth quarter, we actually became uninverted, meaning that there is kind of at points in the yield curve a positive slope.
Where you make more for the longer bonds than you do for the shorter.
Correct. And it's going to be interesting to watch, because many people, economists will say, when it becomes uninverted, that's actually when your recession risks perhaps are the highest. Yep. But again, in prior webinars, we've talked about the components of what goes into a recession call. We didn't include it today, but none of them are really anywhere close.
Yes. And along with the credit markets, we monitor the high yield spreads. So, you know, a little bit of movement here, but not a lot.
Not a lot, and it's been a downward movement. And if anything, you would say the fact that spreads for high yield bonds are so narrow versus kind of in prior periods of financial stress when they've been higher, this is kind of suggesting that the economy from a market perspective looks to be fairly stable.
Now, the third component of the dashboard, valuations, and this is really important, corporate earnings. So touch on where we stand as it relates to corporate earnings.
Yeah, so valuations have been negative for a time, but one of the things that we have seen
and negative, just to clarify, red meaning that stocks have been highly valued. So
good point. Yeah,
I mean, everybody likes to have highly valued stocks, but negative from a component of looking forward into the future.
Yeah. But the good thing we're seeing, and we'll show this later too, is that corporate earnings the growth rate is looking like it's starting to increase. And so from that perspective, that should provide some comfort level for people, that maybe valuations won't become cheap, but maybe they're going to flatten out a bit.
Got it. And I think we're going to touch on corporate earnings and valuations a little bit more in a few minutes here. So in the meantime, let's transition over to the sentiment and look at the market trend.
And it has been green and has been green for a time. It's one of our actual strongest factors. And that's really reflective in why you know, it has been such a positive factor. The markets have done very, very well. And from a sentiment standpoint, things look good. And we do know over time there is a momentum aspect to the market. And so that's very suggestive that this year, from a sentiment standpoint, things are in positive territory.
Got it. So overall, the composite is still showing decent overall positioning. I think we put it right now at neutral, but it's headed to slightly positive, or that new shade of green, over the next quarter or two. So the trajectory is more positive than it is negative.
I think that's a fair way of looking at it.
All right, so let's summarize what's happened in the markets. And we're going to first look at the last couple of quarters, Q1 specifically, or excuse me, Q4 specifically, where we have pretty much across all of the US equity sectors positive performance. But then once we go outside the US for the quarter, it was negative. On a one-year basis, these numbers are pretty astonishing. In the US, all double-digit performance, obviously S&P 500 being the strongest of the three. But even in the international markets, we've got decent performance. And I guess what I would really point out is, as you look at the international equities and the emerging market numbers, let's start with like that 5.5% on a one-year basis. It's only 5.5 because we had to convert from local currency back to the US. And remember, the US dollar has been super strong. If we didn't have to do that conversion, international would have actually outperformed US small cap. So, but again, that strong dollar has definitely taken away from international emerging markets and even our global fixed income, which we'll see on the next slide. So global fixed income for the year was down 4%. Had we not, dealt with the currency issue, it would have been up 5%. That's a pretty big swing. The next slide talks about growth versus value. So just to reiterate, for those maybe new to the webinar, let's say as you look at the chart, the large cap, where you're investing in big US companies. That's what large cap represents. Within that category, some companies are tilted more growth, others more value. And Jonathan's going to walk through a sector allocation in a few minutes, but think about growth being more technology oriented, value maybe being more financial oriented, financial stocks. During the quarter, what did we see, Jonathan?
We basically saw large cap growth companies did better than large cap value companies, and very same trends for the year.
Yeah.
And again, very similarly in mid cap, with growth beating value for the quarter and the year, and also when we look at small caps. But of course, the small cap performance was pretty flattish in the fourth quarter, so it doesn't look as dramatic. But that was a trend we also saw for the year.
Yeah, and I mean, this kind of outperformance for the year, I mean, that's pretty, especially on large cap. I mean, 36% versus 12% for the year. I mean, that's a pretty stark difference. And really, what was the underlying driver of that?
It really came down to what's in the growth part of the market and what's in the value part. And so clearly, when we look on the bottom part of the slide, the growth area, we had communication services up 40%, we had technology up 37%, and consumer discretionary up 30%. So 3 of the 4 components had very, very high returns. So healthcare, obviously hurt in the fourth quarter and was up a little bit. But when we look at that relative to value on the top half of the slide, you're going to see materials was down double digits in the quarter, kind of flattish for the year. Really the best component within value were financials, but many of the other sectors were negative in the fourth quarter and showed more modest returns relative to growth.
Got it. Now, there's been a lot of discussion around the Magnificent Seven, that those 7 stocks are really driving the vast majority of performance that we're seeing in the S&P 500 or one of these other sectors. Can you speak a little bit to that?
Yeah, so when we look at returns, just on a price basis, the S&P was up 23% last year. The Magnificent Seven, those stocks were up 48% and contributed 55% of the S&P 500 return. Now, the other 493 stocks were up 10%, which is pretty good.
Yeah,
that's a good year. But just how concentrated the performance has been, there's a lot of talk about that. But if we look on the right side, and we'll actually talk more about this in other slides, but the green on the earnings growth is Mag 7, and the blue is everything else. And so really, when we look at the progression of the last couple of years and the quarters, the Mag 7 earnings have been substantially better than the rest.
And earnings drive valuation, hence
correct.
That's why they've done better.
And then really, when you look at the Mag 7 being technology companies, their profit margins are so much higher than the rest of the market.
And that really, we didn't touch on this. I don't think we have a slide on it necessarily in the webinar, but that also explains why US is outperforming international, because most of those Mag 7 are all US companies. There's not as much technology exposure in the international markets as there is in the US markets. Now, this was an interesting slide that you and the team put together, showing the performance just before the election and the performance since the election. And what should we glean from this?
Well, we certainly saw some excitement in the days heading up to the election. And then I think post-election, it was a case in many areas where people kind of looked at what did the election potentially mean. And so we saw things pull back a little bit. Now, the Magnificent Seven or Mag 7 was still very strong during that period.
And since even the end of the year, many of these numbers may still, or at least a couple of these numbers are still negative, but most of them have improved since 12/31. Is that correct?
Yeah.
Okay.
So the equal weighted S&P 500 and Russell 2000 are still down, but they're not down as much.
Right. And the others are
now positive.
Yeah. Okay. I just made reference to international, so let's touch on the international performance and how it did both in the quarter as well as for the year.
Well, the quarter, because we reported on a US dollar basis, was kind of terrible.
Yeah.
When we look at the annual returns, certainly better. But when we look at it, certainly there was a lot of volatility in China last year. It was down in the fourth quarter, but it had a good year. On the other side of the equation, Latin America had a pretty terrible year, both in the quarter and for the year.
Yeah. And you had made reference to bonds, and you made reference to interest rates moving up in the fourth quarter. So how much did they move up? What did that look like?
Well, so interestingly, while the Fed has been cutting short-term rates and now they're paused, what we saw while that was happening is we actually saw longer-term yields, so 10-year treasuries and things beyond. We saw those yields go up, and at one point the 10-year treasury yield was almost up a full % from its bottom. And a lot of that was the market reassessing the Fed and how many cuts they would make this year. And so in December, they did cut that from 4 to 2. But what we did see in the fourth quarter is the yield in that 10-year treasury and beyond, those did go up.
So just to be clear, the cut from 4 to 2 was they were projecting to make 4 cuts in 2025 throughout the year. They said rather than 4, maybe it's going to be more like 2. Right. And the market responded accordingly to that. And of course, when interest rates move up, prices move down. It's an inverse relationship. So that's why when we're looking at this chart, we're seeing all the fourth quarter numbers basically break even at best or negative.
Yeah, absolutely. The other thing I'd point out is we showed that one slide where high yield spreads had narrowed. Well, that's actually one of the reasons why high yield really stands out for the year as having such high returns.
Got it. So we've talked about what's happened in the markets, both the equity markets, whether it's US, international, and we also talked about what's happened in the bond markets. But let's talk about our economic outlook as we move forward. So as it relates to the economy, we think, again, getting back to the dashboard, moderate but stable growth. Consumers are out spending. I know there's been a few maybe dents in the armor with regards to spending or substitution, but they still seem to be quite strong and quite willing to go to stores. Inflation's been a little stickier than maybe what people would hope, but it still seems like the most likely direction for the Fed to move is down. It's just probably down slower than what maybe the market is looking for. And then of course we have all of the unknowns, including some of the wild cards that have come up with regards to the debt, which well, frankly that's nothing new. I mean, we've been talking about that for a while, but the discussions now around tariffs and what kind of impact that could have. That always could impact the economy and the trajectory. Internationally, you always have geopolitical risk, but hopefully they continue to be manageable. Mostly we're seeing global rate cuts.
We've seen a couple in the last week or so.
Yeah, so that's good, and maybe seeing some improvement in the industrial production in China. I mean, that's kind of honestly a wild card, China.
Yeah, they definitely, as we had mentioned last quarter, did put in some things to try to stimulate their economy. Now the question is, does that hold, and does the Chinese consumer respond? But the real estate market still is pretty weak.
Yeah. On the flip side, India and Japan continue to look to be bright spots in the international economy. Coming back though to the U.S. economy, touch on this kind of tie between economic growth and demographics.
Yeah, so we've talked about the U.S. consumer has been very resilient and has continued to spend. We also know that the markets have done very well over the last 5 years. Real estate assets are up. What this is showing is the green line is those aged 70 and older in their share of the U.S. household net worth. And so you're going to see for decades, it kind of hovered around that 20-ish% range. And then you'll see really in the last 15 years, that's been moving up, and it's now at roughly 30%. I think what we're seeing in that is obviously we have a graying population across the Western world, so that world, it includes the US, includes Europe, but people save for their retirement and they have assets.
Mm-hmm.
And so with that movement into an older demographic, I think that has actually made consumer spending maybe a little less cyclical, because we know retirees kind of have their bucket lists, so to speak. And so I think coming out of the pandemic, where there wasn't travel and the ability to do those things, I think we've actually seen maybe a tick up in spending by this demographic.
Good point. Very good point. And then here we're seeing how even a strong labor market can also support spending.
Yeah, and so we've seen some areas that have been a little bit weaker when you look at credit card debt rising, but the reality is we've seen some wage growth, and now that inflation has backed down, we're actually now seeing positive real wage growth, which also is supportive of consumer spending.
Well, you just mentioned inflation a couple of times. Give us kind of an update on the components of inflation.
Yeah, so if we look on the right side, one of the things you'll kind of see is the slope of the decline has kind of flattened out. But let's look at shelter. Shelter is down from its peak, but that sort of decline has kind of slowed. And that's, I think, where a lot of the stickiness comes into play. Auto insurance has been another factor where, again, we're seeing price increases this year. And so that's a component we never even talked about in the past, but in the last couple of years is much bigger. And then kind of finally, it's really this consumer spending on dining out, recreation, trips. We've seen some inflation because demand has been high.
Yes, yeah. Good. Well, then let's transition into our outlook on the markets. That was kind of our discussion on outlook of economy, but what about the markets? As it relates to equities, we certainly don't anticipate, I mean, things could change throughout the year, but at this time we don't anticipate a massive and prolonged pullback that would cause 2025 to be a disaster. Maybe we shouldn't expect another 20+% return in the S&P 500, but still strong performance, which, by the way, we didn't really touch on in here, but when we always talk about these 20-25% returns in the S&P, that's not necessarily reflective of a diversified portfolio, right? I mean, a diversified portfolio is going to have some small cap stocks that were up half or a third of that, or some international stocks, or even bonds that were up a couple of percent. So that's the way diversification works. But again, we still think good returns. We're likely to see more volatility, and an intra-year pullback, not at all unexpected. As a matter of fact, if we don't have an intra-year pullback, that would probably be more of a surprise because it happens almost every year. It's just by the end of the year, we've recovered from the pullback and people don't even realize that it happened. Certainly Mag 7's priced for probably perfection.
But we might get it again.
We might get perfection for sure. We talked about wild cards being, geopolitics. Overall though, I would say we're more positive than negative, and certainly on the long-term outlook, more positive than negative.
So now again, we're kind of getting back to the Mag 7, and we've talked about their high valuation, and we kind of touched on the earnings growth. But really, when we look at 2024, the earnings growth for those top 7 stocks was up 32% relative to the rest of the S&P, where we saw 3% earnings growth. Okay, and that's on top of 2023, when those Mag 7 stocks had earnings growth and the rest of the market actually saw earnings declines. What we're looking at in 2025 is actually those top 7 stocks probably growing earnings again in a 20 to 25% range, which is, yes, below last year, but that is still really, really strong. Now, the positive side of that, though, is that the other 493 stocks, they're expecting potentially double-digit earnings growth. Now, the reason I say potential is they tend to start the year high and then they come down. But to the extent that we see this earnings growth improve this year for the other areas, that should be helpful.
Got it. And really, earnings, as I made reference to earlier, drive valuations. And so here we're seeing the valuations.
And again, we've talked about the Mag 7 companies. So here we're kind of broadening that to the top 10, which again are tech companies. So you can argue that they're almost 150% above the average valuation and that they're expensive. Okay. Then we look at the other remaining stocks. I think that's a better way potentially of looking at it versus the S&P. But as we've said before, valuation does not drive markets. And so again, maybe on the margin, these 7 stocks don't show the same earnings growth as last year, but the earnings growth is still going to look good even relative to the rest of the market. And they have high cash, revenue growth, high margins,
pricing power.
Perhaps what this valuation is really rewarding them is for those kind of quality statistics.
So the question is, with the markets up double digit for the last 2 years, how long can this last?
Here we're showing bull and bear markets historically. And so we have the red circle. We're up 70%, and this bull market is 27 months in length, which sounds like a lot. But when we compare it to other cycles, we've seen, very long bull market cycles in the past.
So just to look at this, the blue, I think it's blue or turquoise. What?
Blue.
Okay, blue. The blue bars going up are the bull markets. So this one's up 70%, 27 months. Last bull market was 103% for 25 months. And the one prior to that was 400% over 133 months. That's a pretty big one. But according to this chart, not the biggest. 582% over 150 months was back in the late 80s, running up to the technology bubble bursting. That's an interesting chart. Of course, what I would probably focus on most, if you're really going to look at this for any forecasting is look at typically how minimal the downturns are, the bear markets. I know when you're in them, they seem so devastating, but when you put it in scope of history, those bull markets just don't look all that intimidating relative, or excuse me, the bear markets don't look all that intimidating relative to the bull markets. It's a good chart. Let's go back then to our outlook on the markets. We've talked about the equity market outlook. How about the fixed income market outlook? And here's where we already made reference. The Fed likely have reduced the number of rate cuts they're going to make in 2025. Right now they're saying 2. I mean, that could change next month. But the direction is probably down relative to being up. Yields are looking pretty attractive right now for bonds. I mean, a lot of people are asking, should I still be in bonds? Like, this might be like a great time given the yields are so much more attractive than they were even a couple years ago. Especially if rates start going down, then you get the price appreciation on top of those high yields. So I think bonds continue to have an important component or place in the portfolio.
So to put the bond yields we're seeing currently in perspective, we wanted to show you where they are kind of on a total return basis compared to history. And so one of the ones we wanted to pull out and highlight was the investment grade corporate bonds. And so here, what we're showing is that the total return and this goes back to about 2000, is about 5%. And so interestingly, that's about where we are currently. The other thing to glean from this and from the other two we're going to show is that the dark blue color that you see is the coupon return or the yield. And so what you're going to see here is that you can barely see over time much price return. It is really truly the yield that gives you that long-term return. Next, we'll kind of highlight the municipal bond area, and here we're looking at taxable equivalent yield. And again, we're at very attractive yields. And then kind of finally, we're looking at kind of the aggregate bond index. And again, when we look at that, that's pretty much all coupon return. And the reason that's important is we're looking at coupon yields in that 4 to 5% range for a lot of bond funds. And again, as we've shown historically, that's a good return.
Sure. Well, thank you for that, Jonathan. Really appreciate the discussion, especially around bonds, because I think those are maybe one of the more misunderstood areas of the market.
I think they've been frustrating for people too, because they didn't protect in 2022 when people hoped they would, but we're at really low yields.
Yes.
And then last year, in the third quarter, we had nice returns. And then in the fourth quarter, we saw long-term interest rates shoot up, and that brought the return down. But again, we're looking at good solid yields this year.
Got it. Well, let's touch on some New Year planning tips. We're going to go through these relatively quickly, just as reminders for folks, particularly those that may not be working with a SilverOak advisor, because hopefully if you are working with a SilverOak advisor, they're talking to you about most of these items anyway. But first and foremost, don't adjust your risk tolerance due to recent market performance. It's called recency bias. People think whatever's happened most recently will continue forever, and we know that just is not the case. So just because equities have done really well, don't go out and get super aggressive unless something has changed in your life to really change your longer term risk profile. Remember April 15th, I don't think, hopefully people can forget that. The tax filing deadline's coming, so pull together your information, get it over to your tax preparer as soon as possible. I'm sure they would appreciate that. Remember, there are foreign bank account reporting requirements, particularly if you have more than $10,000 in a foreign bank at any time throughout the year. It's not necessarily at the end of the year. It's at any point throughout the year. We need to make sure that there's some additional reporting on those accounts. Now's a great time to start planning for 2025. So if you're looking all over the place for your paperwork for 2024 and you're frustrated and you're just kind of beating yourself up, well, now's a good time to say, okay, I'm not going to do that again, and make a good filing system for the information for this next year. Review 24 spending. I personally think everybody should do that, whether you're per se on a budget or not. Reviewing your spending is pretty much the only way you can kind of understand and prioritize your spending habits. If you have access to an HSA, I certainly would encourage people to use it. That's a health savings account. There's a lot of great tax benefits for HSAs. And of course, if you have access to a 401k, I encourage you to try maxing out your 401k, particularly if there are matching dollars from your employer. A weird thing this year going into effect is this new catch-up. For those that are age 60 to 63, you can actually put an extra $11,500 in. Don't ask me why. They've kind of earmarked the 60 to 63 and not 60 to 65 or 60 or older or whatever, but you got that little period there where you can put in a little extra. You review your estate documents in conjunction with that. Look at your beneficiary designations. Rebalance your investment accounts. Obviously, all the clients we're working with, we're in the process of doing that on their behalf. Look at insurance coverage. Okay. Get a copy of your credit reports. We like to request that for clients every couple years. If you don't have your credit frozen, and we talk to our clients about this all the time, if they're not frozen, make sure you freeze them, or at least if you choose not to, understand the risk of not doing so. Max out your IRA contributions if you can. Get a Social Security statement online. Get your IRS IP PIN. I think we talked about that in our last webinar. And we actually, August 12th, sent email communication to all of our clients on how they do go through the process to get an IRS IP PIN. And for all of you that went through the headache and heartache of filing the BOI, the Beneficial Ownership Information Disclosure, well, unfortunately, that may have been all for naught, because there was a circuit court that basically put a hold on that filing requirement. Now, we don't know if it's going to come back and be a required disclosure or not. We assume with this administration, probably not. But if you did it, don't be too upset with yourself. It might still come back into law, and you will have completed it without having to do any more with that. So I know we went through those quickly, but I think that gave us good time to then get through our insurance series. And again, today it's about long-term care insurance. We did have a review of auto, home, and umbrella insurance in October of 23. So if you look at our website, you can find the October 23 webinar. And we reviewed the personal property and casualty insurance at that time. And in October of 22, the year prior, we reviewed travel insurance. So now we're going to talk about long-term care insurance. So Jonathan, tell me what this is even designed to do.
Well, it is designed to bridge the gap and cover costs that your regular health insurance or Medicare does not cover. And so thinking about that, what could that be? That could be a chronic medical condition. A lot of people That would mean dementia, Alzheimer's. You know, of course, there are other physical ailments too, but I did highlight those two. Um, and then it might not be a chronic condition, but you might not be able to perform many of the routine daily activities that you might have in the past. That includes bathing, dressing, toileting, transferring, so getting out of bed, going to a chair, walking, eating, and continence.
Got it. And a lot of policies require your inability to do two of those activities of daily living. Not all, but most policies, many will say, if you can't do two of them, then presumably the benefits could kick in.
And so the issue is that if you need help, you're not going to get coverage elsewhere. So you're going to either have to pay out of pocket, or in this case, have long-term care insurance.
And I guess I didn't open the discussion with this very, very important point, and I really should have. We do not sell long-term care insurance. Actually, we don't sell any insurance. So we're not discussing insurance today, nor have we ever discussed insurance for the purpose of making a buck, because we don't sell it. We don't get commissions from clients that decide that they want to buy it. We don't get referral fees to send you to an agent that does sell it. We receive none of that type of compensation, period. We're discussing it because we know our clients will sometimes inquire and wonder, should they have it? Should they not have it? And hopefully we're having those discussions, but we thought it would be a good conversation to have more broadly. Now, most policies, a good policy anyway, is going to cover all of these types of care, correct?
Correct. 20, 30 years ago, the newer policies at the time might have just covered nursing home care, but now we're seeing care given much more in the home, and so the newer policies do include that. And then on top of that, assisted living, which is more care than, say, an independent living, but less than a nursing home. And then, of course, there are adult care centers.
Yeah, 20 years ago, you didn't even see those.
No.
Maybe even 10 years ago.
Yep.
And, you know, I get the question, well, you know, really, why do I need this? Because I got Medicare. Like, doesn't Medicare cover this?
Unfortunately, it does not.
No, it doesn't.
So it doesn't cover supervision, custodial care, or help with day-to-day activities.
And even the other stuff is very limited.
Yep.
So yeah, I would not rely upon Medicare, or even in this next bullet point, Medicaid. Frankly, hopefully nobody on today's webinar is ever in a position where they need Medicaid, because that basically means you've depleted all of your assets, or at least almost all of them. So why should someone consider, not to say that everyone should have it, but why should they consider getting this coverage?
So big picture, it's to protect your savings. You know, there are high costs, and depending on how long you need that care, it could deplete your retirement savings. We also know that care costs are relatively high, but they're likely going to continue to increase, and perhaps at a rate higher than inflation. And so what we're showing you is the costs back in 2023 on an annual basis, and this was from a national survey by Genworth. So if you received care at home, and that's 8 hours a day, by the way, that would be $75,000. And that would include health aids. If you just brought somebody in the house just to help with household activities, be a little less. You know, just going into a day, adult day healthcare is even less still. However, if we look at, if you had to go into an actual nursing home, a semi-private room would be over $100,000, and a private room in a nursing home would approach $120,000.
And I would say, frankly, from what I've seen, I'm kind of surprised these national numbers are as low as they are, because I know we've had clients in these facilities that sometimes they're paying $20,000, $30,000 a month for a combination of the facility and additional services from outside providers. So it can be quite expensive. The real challenge, and I think we touch on it somewhere, is these policies also tend to have maximum benefits, though. So you can buy unlimited benefit policies today. They are super expensive, though.
Mm-hmm.
So you usually have to say, oh, I'll have benefits up to whatever, $500,000 or whatever.
Yep. You have to think of it maybe like getting health insurance. You're getting coverage, but you know there's still other things that you'll potentially have to pay.
Got it. All right. So let's talk about how it works. Obviously, you got to fill out an application. What I think a lot of people neglect to kind of consider is that you actually have to go through underwriting too.
Mm-hmm.
They want to prove, or you to prove anyway, that you are not in a condition already requiring these types of services. So if you don't get it when you're insurable, like any other insurance, you're not going to get it, or the premiums are going to be crazy expensive.
Mm-hmm. You'll need to choose your coverage. Of course, there's a wide range of types of policies, the amount they'll pay on a daily basis, amount they'll pay during your lifetime. And of course, the better coverage you get on the pricing, which is kind of the next consideration, the more you're going to pay. But the insurers are really looking at your age, your health, gender, marital status. And so what I mean by gender is that the data shows that women tend to be in using the long-term care longer, so their rates are going to be higher. Married people actually get a little bit of a break from that. And then again, if you wait too long, from an age standpoint or health standpoint, you won't be able to get it.
Got it.
So once if you're approved, you begin to pay the premiums. Now we've touched upon this before, but essentially using the insurance, you'll have to be in a situation where you can't perform 2 of those 6 daily living activities we discussed. If that occurs, you'll want to contact the insurer, and they'll do an evaluation and then approve the plan of care. The other thing, though, to also consider is there are typically elimination periods in that period, meaning you contact the insurance company, you might already be paying for some care, but many of the policies have 30 to 60 days before they'll start to kick in and cover those costs.
Got it. And the sooner it kicks in, the higher the premium. And I mean, frankly, I think 90 days is a pretty common one, where I see it rather than 30 to 60, like 90 days, and then they begin to cover. And the 90 days is popular because it helps get the premium down.
Mm-hmm. Good point. And then the other thing is recommend looking at purchasing a rider that essentially would allow you to stop paying the premiums once you're collecting. So in terms of things to consider, this is not cheap insurance. Premiums can be high. And so many who might actually need the coverage can't afford it.
Yep.
And then the other side of that is many of the people who can afford it actually opt to self-insure. So for a lot of people, if you're in the middle, that's really where you have to evaluate whether it would be a benefit to you.
And just to throw out an example, this is purely an example, but you got somebody, couple, let's say mid-50s, say they buy a shared care policy, meaning that either of them can use the policy, $500,000 lifetime maximum benefit, and they're in good health, no health issues, probably in the range of $5,000 to maybe $10,000 a year premium total. But you can't think of it as, oh, $5,000 or $10,000, because they're going to be paying that presumably for the next 20 or 30 years. So this is a massive investment when you put it in those terms.
Mhm. You're going to see premium increases. Premiums are not typically guaranteed. The insurance companies can go to the state regulators to ask for premium increases, and they're typically given because they need the health of the insurance company to be intact to pay out claims on all of the outstanding policies. So one way you can really mitigate that is if you have the funds, consider paying a single pay, or I listed a 10 pay. I think I've heard of 5 pays. But in doing that, they're level payments, which really protects you against those price increases.
So you buy a single pay, you don't pay, in my example, the $5,000 or $10,000 a year. You pay one time, maybe it's $150,000, but you pay it once. Then if the premium increases are approved by the state, you don't have to worry because you already paid your premium. Right? You're done. Even if increases are approved for those that are making annual premiums, single pay, you're done. Or when you get through the 10 pay period, you're done. It's a good option for those. Obviously, you have to have a relatively large amount of cash to have that large of an outlay, but it's a good option for some.
And for many, this idea that it's potentially a use it or lose it scenario, meaning that you pay the premiums in and
What if you never need it?
You never use it. And then the kids are looking and saying, why did mom and dad get this policy and pay all of this money out? So one of the potential solutions, and you mentioned this earlier, is a shared care policy where you get it as a couple and you share that pool. And the data shows that in a situation where there's a couple, there's a very, very high likelihood of it being used. And then another potential solution are the newer hybrid policies that really combine life insurance and long-term care insurance. And so if you don't use the long-term care portion, you get that death benefit.
Got it. Now, there can be some tax benefits. I certainly would not buy a policy to be able to write off a portion of the premium, but if you are buying a policy anyway, you might as well see if you can get a tax benefit. There are some state partnership plans. Actually, some states, I know Washington State, they have an extra tax for their state long-term care bucket or pool. You could exempt out of the tax when it was first enacted several years ago if you already had a long-term care policy in place. So I know a bunch of people in Washington State went out and bought the most basic long-term care individual plan they could buy to get an exemption to this wage tax that was going to then apply to them forever, at least while they were working. But you have to be careful and understand what your state offers or doesn't offer. And we obviously suggest you work with a specialist, somebody that is doing this every day. Don't go to your agent that's selling your auto insurance to buy long-term care insurance, because they're just apples and oranges. As I mentioned earlier, we don't sell insurance, but we help our clients decide, do they need the coverage or not? And if they do, we'll help you find the right policy. We'll work with people to help you find the right policy, but we'll only do it in a very objective fashion, with compensation having no role in the discussion, because again, we don't get paid by anybody through that process of selection and such. So a couple last minute SilverOak updates as we've got 1 or 2 minutes left. We already mentioned tax season. We have sent out tax organizers to all of our clients, and actually we've started receiving organizers back. So kudos to everybody. Thank you for getting those back as quickly as possible. Another great piece of news, we have 2 new hires. We have 2 new members of our A team. So welcome to both of those members. Excited to have them on board. Very, very brief IQs update, like 30-second.
Yeah, so having gone through the performance, probably not surprising. It was a more difficult year in small cap and international in terms of absolute returns. Absolute returns in the large cap area, obviously good. Absolute returns, we saw generally good relative returns, especially in the value areas.
Yes.
And then when we look at fixed income, generally our funds did very well. Now, of course, it was a tough year for global bonds.
Got it. With that, we want to thank everybody who attended today's session for taking the time to do so. If you have any questions or suggestions on future topics, I really encourage you to reach out to your SilverOak advisor. If you're not working with one, you can call me directly at 952-896-5701. And from everybody at SilverOak, again, big thanks and have a great afternoon.